this idea that, hey, the Federal Reserve is going to cut rates and mortgage rates are just going to follow. I could see a couple scenarios where that doesn't play out that way, at least in the short term.
You're totally right that everyone was kind of thinking, yeah, rates will come back down, kind of along the lines of inflation was transitory, right? So
Sure.
these higher rates are probably transitory, and there's probably a little bit of recency bias in there, right? We had super low rates for 15 years, and now we have higher rates, and they're like double what they recently were. So we're like, well, it's got to come back down, right?
This is Successfully Retired with Hamilton Brandenburg. Okay, got my friend Austin Preece of Preece Financial Planning back here today. We're going to talk to you about interest rates, mortgage rates, bond rates. How are they all related? Inflation rates. This is not usually like an economic and stock market style podcast, but I wanted to talk a little bit about, because we do have probably a rate cut around the corner. That's definitely been talked about a lot for the Fed funds rate. So for our listeners, especially for a lot of folks who maybe have bought houses during COVID or right after COVID, as interest rates on mortgages went up, there was like this big mentality I heard a lot of, hey, we have to buy this house. Yes, it's gotten too expensive and the rates are too high, but we can make the mortgage payments. It's going to be tight, but we can do it. And we're just going to refinance when the Fed cuts rates around the corner. And you hear a lot of realtors, marry the house, date the rate, right? Nothing against our realtor friends. We want to keep them employed too. But this idea that, hey, the Federal Reserve is going to cut rates and mortgage rates are just going to follow. I could see a couple scenarios where that doesn't play out that way, at least in the short term. I mean, would you agree? And I thought we should maybe kind of kick those scenarios around, especially for people who are looking to buy a house and they're maybe considering taking that lender approval letter and buying with the max amount. With a refi around the corner, what does that realistically look like for your chances of refinancing to a more affordable rate down the road? So to all that, let's get into a discussion today about what is the current interest rate landscape? What does the Federal Reserve actually do? And how could this rate cut potentially affect or not affect mortgage buyers?
Yeah. No, I mean, there's really a lot there to unpack, right? And you're totally right that everyone was kind of thinking, yeah, rates will come back down, kind of along the lines of inflation was transitory, right? So these higher rates are probably transitory, and there's probably a little bit of recency bias in there, right? We had super low rates for 15 years, and now we have higher rates, and they're like double what they recently were. So we're like, well, it's got to come back down, right? What goes up must come down. Where we were talking about starting is like the difference between mortgage rates and like short-term interest rates, right? Like what the Fed actually controls.
That's a really good distinction. Why don't you talk a little bit about that, or just kind of for our listeners? Well, first of all, like tell me just very briefly, what is the Federal Reserve's job actually to do, and how does that affect their setting of interest rates?
So Federal Reserve has the dual mandate, right? They're supposed to do their best to keep inflation around 2%, not too much higher, not too much lower, and do their best to keep unemployment, low. Keep the U.S. at full employment is kind of what, no one knows exactly what that means, but we're probably pretty close to that. Our unemployment rate is 4.2, 4.3%, somewhere in there. So that has ticked up recently, which is part of the reason that they're looking at doing a rate cut in September. And really the rate that they control is, I think they call it like the overnight. Well, it's the federal funds rate, and it affects the overnight rate, which is the rate that banks lend to each other at. So right now, what are they in the range of 4.25 to 4.5, I believe is where it's at, that federal funds rate. And typically where we see that as consumers is more in like money market funds or high yield savings accounts. That's really what that impacts most for us, that Fed funds rate. But
because it's essentially a tool to get you to not spend money, to say, hey, listen, if you've got money, we're going to boost the rate that banks can borrow from each other overnight. So you can risk-free make, 3 or 4% annualized at this rate
Hmm.
by keeping your money in cash and by
Hmm.
not spending that money as both individual consumers and as companies. That means you're
Hmm.
not putting a lot of money into hiring new employees because you can make, say, 4% on your cash. So you don't
Hmm.
need to grow your margins. I mean, I looked at, like, I think Walmart's, after, like, their net profit margins were like something ridiculously low, like 2%,
Yeah.
after everything. So, like, if you're a really big corporation, and not saying that Walmart's balance sheet is so simple that they're like, well, just put it all in cash, but
Yeah.
it makes it, for big companies and for consumers alike, it gives you a really good reason to not do anything with your cash. Whereas when
Yeah.
rates are low, you have a great motivation. Hey, I'm not making any money on this cash. I'm losing it to inflation every year. So I need to
Yeah.
invest. I need to go ahead and buy that car because I can get 0% for 72. I need to go ahead and hire that employee because I need to grow my business.
Yep.
So it's really a way of keeping cash in or out of your money market and savings account versus deploying it, if that's what
Yeah.
you're saying.
Yeah, yeah, absolutely. And I think we need to talk about how there's kind of a carrot and stick incentive there, right?
Yeah,
You can keep your cash and make easy money on your cash right now. But if you want to borrow to grow a business or to buy a
sure.
house, the these rates are also correlated. They're not exactly the same. But if we have higher Fed funds rates, we typically have higher borrowing rates as well. Um, and I I think where that correlation can kind of break down a little bit is you know we have this concept of a yield curve where um, short-term rates, overnight rates, the Fed funds rate typically is lower than longer-term rates. If you're buying a house or if you're borrowing to invest in a business, we're talking more long-term rates there, right? You need that money for if you're buying a house, 30 years, right? Is kind of the time frame there. Um, so typically, a normal yield curve has the short term end with lower rates and the long term end with higher rates. Sometimes we see an inverted yield curve, which we've seen a lot in the past few years,
Yeah.
which historically has been a good indicator of a recession. Depending on your leanings, it hasn't really panned out that way this
Say,
time.
Michael Burry would tell you to sell regardless.
Yeah.
Just sell,
Oh,
sell
yeah.
everything. Yeah.
I
No.
saw that he recently tweeted buy, so
Oh,
he
great.
goes
We're at the
back and
top.
forth too apparently. Yeah.
Great. That's it. The inverse Jim Cramer 2x leveraged ETF for the
Yep.
win.
Yeah. Oh
Michael Burry,
man.
add him to the list. So yeah, so your mortgage rates are not, so this is something that ties in really close to what you said. You're talking about yield curve, you're talking about short-term rates, long-term rates.
Mhm.
You're talking about the difference between the interest you can make keeping your money in short-term investments like a money market fund or a short-term CD versus the
Mhm.
interest you can make if you were to buy something that investors would consider a risk-free investment, which is a 10-year US Treasury. So a
Right.
10-year US Treasury is literally a bond that the federal government issues that says, hey, hold this for 10 years and we're going to pay you X rate. So
Yep.
my question too, so for you, and we're going to kind of explain this to our listeners. Let's talk about how the 10-year
Mhm.
Treasury affects mortgage rates, maybe more so than the Fed funds rate that we're about to see
Mhm.
cut potentially here in September.
I think we're in a good spot to jump in there. So yeah, kind of like we mentioned, longer term rates matter more for borrowing.
Sure.
And so because of that, typically mortgage rates are more correlated to the 10-year interest rate than they are to the federal funds rate, as you just kind of said. Um, and really, I guess part of what makes up the 10-year interest rate too is sure a little bit of what the federal funds rate is. We typically see a higher 10-year rate than the federal funds rate. But there are also growth and inflation expectations built in there too, because you've got to hold this for 10 years in order to get your money back. So, you
And
know,
the reason, and let's pause there for a second too, because I
yeah.
want to make this clear for people who are not super investmenty, and don't live and breathe this every day. The
Yeah.
reason why your mortgage rates are going to be more closely tied to whatever rate people can get on the 10-year Treasury than the Fed funds rate is a couple reasons. The first reason is because of what actually happens to a 30-year mortgage. When you go and buy a house, you get a 30-year mortgage. First of all, your 30-year mortgage doesn't have an average lifespan of 30 years. You're typically looking at more like 7 to 10 years before people have sold houses, moved, or refinanced, or like there's a shorter life cycle than 30 years. So when I started my first job at it was called AmeriCredit, it's now GM Financial, and we were an auto lender, and like the first thing I had to do was do this little class called like the life of a loan, and you learn that with car loans, and this actually applies to mortgages as well. The way that the lenders make money is they will basically lend this money and turn around and sell it to investors, right? So they're going to package up loans a lot of times and sell them to investors, and investors are looking at, okay, how do I make interest off of my investment? So if the investors who are buying these loans, if they can get a safe 4% by just buying a 10-year treasury, risk-free, right? And they're going to take on some risk by buying this mortgage-backed investment instead. That mortgage-backed investment is going to have to pay them a higher rate, right? Are you going to take more risk to get the same level of interest on one versus the other? No. So that's where you're saying, okay, that is why the 10-year treasury, in my opinion, that's the simplest way I've understood it for why it's more connected to mortgage rates than what the Federal Reserve's doing and raising and lowering interest rates.
Yeah.
So
yeah, and
because that's the
it,
risk-free amount that an investor can get. So that's why your mortgage is higher.
Yep. Yeah, exactly. And so historically, that spread in interest rates, we call differences in interest rate spreads for, again, those people who aren't very investmenty. I loved that word.
Yeah, it's made up.
Yeah, that spread has typically been 1.5% to 2%. So if your 10-year treasury rate was 2%, your mortgage rate was 3.5% to 4%.
All right, can I share a screen that shows what the spread is right now?
Yeah, absolutely. Let's do
it. All right, let's pop this up. Can you see this? Okay.
Yeah.
All right, so just so this is where if you're listening on Apple Music, maybe you want to pop on my YouTube channel, but you're looking at three things here. All right, you're looking at the little blue dots. That's the Fed fund rate over the past number of years. Then your red dot or your red line is how much interest you can make on the 10-year treasury, and the blue line is the 30-year fixed rate mortgage rate. So it's exactly what you're saying. So you're seeing here the difference between the 30-year mortgage is it moves in lockstep with the 10-year treasury. So that's the first thing that's interesting to see. But the second thing too that's interesting to see is if we look back here. So this is November of 2024. So this is pretty recent. Those blue dots, we're seeing the Federal Reserve cutting interest rates, and we're seeing mortgage rates and the 10-year treasury going up and not down. The reality is they're not perfectly connected. And we could be in a situation where the Federal Reserve cuts rates as we're expecting in September, and mortgage rates end up going up like they did in 2024.
Yeah, and what I think is kind of interesting about that chart too is it right before the rate cut, you can kind of see the 10-year came down a little bit, and people were expecting that rate cut was going to happen, and then the rate cut actually happens, and the 10-year pops right back up. So that's kind of one of those what is it, buy the rumor, sell the news sort of situations.
That's right. That's right. Well, why do you think that is? Why do you think that if the Federal Reserve is cutting short-term interest rates, why would we be seeing long-term rates and mortgage rates go up, making housing less affordable and making mortgages less affordable?
Yeah, really interesting dynamic there. My opinion, what I think is, the Federal Reserve, especially at that time, they weren't too worried about unemployment last year. There were, some not great readings that came out. The Somme rule was triggered, whatever the heck that is. Go look it up if you need to.
I remember that.
We won't get into that. But they're typically looking at inflation, right? And so when interest rates or when inflation is coming down, they're going to cut interest rates because they don't need interest rates to be quite as high to tamp inflation down. So I think what happened there is you saw the Fed cut interest rates, and people kind of got the idea, hey, this might actually be a little bit too soon. This might cause inflation.
Yep.
which when people are afraid that there's going to be higher inflation over the next 10 years, uh, it causes them to want a higher rate on the 10-year treasury. So that's kind of what I think happened. But what are your thoughts on that?
No, I agree. I think for investors and for just regular consumers, the thing to keep in mind is that your 10-year treasury rate, while the Fed, if the Fed meets and they cut rates, it could have that effect where can we do trickle down rate economics? Is that going to be a thing? I'm gonna make that up. So
I
yeah,
don't know.
it could trickle down and affect the 10-year treasury. There could be some connection there, right?
Mm-hmm.
But inflation is a big thing because if inflation is growing faster than expected, or just if consumers or investors are like, hey, I need to make more money. I need to make my money make more money because inflation
Yeah.
is higher,
Mm-hmm.
then you're going to see those 10-year treasury rates go up. So inflation is a big, I would say, leading cause of 10-year treasury rates and mortgages going up. One of the scenarios that I see possible, and I'm not sure that this is true, I don't know how this will play out, but you could see that, we've gone through the whole year with kind of tariffs being on the table, off the table, kicked down the
Mm-hmm.
road. I don't know what the result's going to be of the tariffs. I'm not an economist, but tariffs oftentimes do have at least a short-term effect of causing costs of goods and inflation to increase, because it's essentially a tax that the consumer pays.
Mm-hmm.
The person who's selling the thing doesn't pay the tax; they just raise their prices, and the consumer pays the tax on the
Yeah.
imported good.
It's kind of like
So,
if we put a sales tax on something. You
100%.
in Wisconsin here, sales tax is 5.5% in most counties. So you buy a soda Quick Trip. Oh, you guys don't have Quick Trips down there. Gas
Oh no,
station.
we
Sorry,
do.
everybody.
We got
You
quick
do?
trips. Yeah, we have
Oh,
quick trips.
but ours is spelled KWIK, not
Yeah, nope, we
QUICK.
don't do that. We don't do
Yep,
that.
they're different. uh, anyway, so if you go buy a Mountain Dew, $2 in Wisconsin, you're gonna have whatever that is, 11 cents added to it, right? So
Sure.
that's kind of exactly what tariffs typically do, right?
That's kind of like so Washington and Oregon. I want to say Oregon has no sales tax and Washington has no income tax, but it could be reverse. I don't
Yeah,
remember. I
I
stayed
think you're
on the
right.
border between the two states for a few months last year, and you'd hear about people who would like live in one state and go to the other state to buy all their big purchases, which
Yeah,
is actually technically illegal because you're supposed to pay
yeah,
it based on the state that you live in, not
right.
based on where you purchase it. But
Mhm.
I'm sure they self-reported all the
Yeah,
time. But
I'm sure
that's a
they
good
did.
example of like,
People
hey,
are.
this is inflation. This is what inflation does. It
Yeah,
makes it more expensive here
yeah.
than it is there. So that drives people's behavior. It drives the buyer's behavior. And
Hmm.
adding a tax on top of a good, I don't care whether you think that's the best idea in the world or the worst idea. Doesn't affect me one way or the other. But
Yeah.
it does make that thing more expensive, which could have at least a short term effect on inflation going up,
Hmm.
making the 10-year treasury go up,
Hmm.
making mortgage rates go up, even as the short term rate comes down. Does
Yeah.
that seem
Yeah.
plausible to you?
Yeah, it does. And I mean, it's interesting right now. People have tossed the word stagflation around, basically meaning high unemployment and high inflation. And
Yeah.
if you look at the period of stagflation in the 70s and what we're experiencing now, it's very, very different.
Oh, big
So
time.
I think that's maybe a little alarmist, but yeah, it's really interesting to see all of this happen. And early on, sorry, I'm going to do a little bit of politics here, but
Go
early
for it.
on when Trump took office, you didn't hear a whole lot of, like telling Jerome Powell to cut rates. If you remember in 2018, there was a lot of that.
Yeah.
So I was expecting it right away. But what uh, what happened instead is they kind of focused on other economic policy agenda, and it kind of seemed
Sure.
like maybe Scott Bessent was saying, "Hey, Mr. President, we really, cutting short-term rates isn't going to make people necessarily happier because what we saw last year when that happened, mortgage rates actually went up and inflation isn't really as far down as we would want it to be, so that might actually be bad, So there's and that's part of the reason for the independence of the Fed, right?
Yes.
If we had someone who wanted interest rates cut to kind of juice the economy short term, you could go into this inflation spiral because of that, right? And then really what it does is it makes long term borrowing costs actually much more expensive potentially because of that, because of this dynamic that we've seen. that we've
Yeah.
seen. So um, that's all I've got on politics. I just think it's really interesting how that all interplays. And
Well, to your point, the risk of cutting rates too much too soon. So,
mhm,
and I'm thinking about it just in very simple, like what have I been through or read about? Like when we got into 2020 and COVID,
mhm,
again, I'm not an economist, but I was like, man, I feel like this cut to zero rates is too much too soon. And then you had trillions of dollars of stimulus happening.
mhm,
So this is a perfect example of
yeah,
hindsight's 2020, and
yeah,
I would not want to be running for office through COVID, right? What a
no,
tough time to be a public servant in
mhm,
politics and administration. But um, really low interest rates, lots of money hitting the market, that absolutely had the effect of just shocking inflation.
mhm,
That combined with housing starts creeping to a grinding halt.
mhm,
So now
and
every
supply chain
money's
issues, right? I mean, it was the
yes,
perfect storm for inflation.
exactly, and now we're dealing with long-term inflation that's tough to manage and
Mhm,
higher interest rates.
yeah,
And so to your point, that's where, a rate cut, could it be important? Could it be something we might need? Quite possibly. I'll let
mhm,
the experts, smarter people make that call.
yeah,
But it doesn't necessarily mean that it's going to make your house more inexpensive. So I
right,
think that one of my takeaways has been, as I'm talking with clients, is if you're, in that transition, you're buying another house, um, and everything's more expensive now, and they're looking at, okay, you're going from a $600,000 home to an $850,000 home, and you can
mhm,
barely afford it. Don't be banking that a rate cut. First, I would say, don't bank that it's going to happen, but if it
mhm,
probably will. But don't bank that rate cut is going to translate to you're going to be able to refinance your house at a more affordable rate in the next 24 months, and then you'll be able to afford it.
right,
Really, really, really be careful and almost assume as a buyer that, hey, if I'm buying something with a 6 or 7% mortgage today, I just
mhm,
need to that needs to be comfortable with my cash flow. Because if
yeah.
it's not comfortable with my cash flow, I can't bank on somebody coming to save me later. Does that
Exactly.
sound fair?
Yeah. Yeah, absolutely. And I think one other thing, as you know, sort of a buyer beware sort of situation, there's a lot of talk of interest rate buy downs for the first couple of years. So maybe builders are buying down the interest rate. It basically means that they're fronting some money in the mortgage so that the
Sure.
first year or two your interest rate is actually lower, which means your payment is lower for the first year or two. But then, and those I've been hearing a lot about those as like, yeah, it's perfect because your interest rate will be lower for a couple of years and then you'll just refinance because interest rates will be low again. Dangerous,
Yes.
danger, right? Because we don't know that interest rates will be lower. And actually, I think something like that is kind of what was happening leading up to the '08 financial crisis. There were interest rate buy downs, and people were getting in over their head based on those lower interest rates up front, and then getting stuck later on. So that can really cause an issue. Biggest piece to remember there is just make sure that on your current budget you can afford it, and that you have a plan for if maybe you're married and have two incomes. What if someone gets laid off? Let's
Yeah.
let's have a plan for the contingencies there.
That could also really, I think, affect people a lot of times, when you're mortgage shopping, in a higher interest rate environment, and let's call it higher than it has been, but not as high as it has been before then. Um, you'll oftentimes look at a fixed rate versus a variable rate. And I think there's
Mm-hmm.
also, that's something that home buyers need to be careful of is, hey,
Yeah.
if I'm buying the variable rate because I'm banking on it going down, just know what your cash flow is.
Mm-hmm.
And because again, a Fed funds rate might not translate to a lower mortgage rate.
Mm-hmm.
I'd love to be wrong on that. That'd be
Yeah.
awesome.
Yeah.
But
Yeah.
my thoughts are closer to, we don't really know what's going to happen with inflation. We don't know how tariffs are going to impact inflation, and
Mm-hmm.
we don't know if we're even moving too late at cutting rates now
Right.
to get what were the last few readings that we had on unemployment. Is that a trend we're going in, or was that a
Mm-hmm.
one-off?
Yeah.
um and then
And
even consumer, or even inflation numbers that have come in the past couple weeks from PPI
mm-hmm. Yeah.
ticking up pretty hot. So that, to me,
Oh
those are
yeah.
two big like red flags that say buyer beware, get a fixed rate mortgage,
Yeah.
and make sure it's affordable
Yeah.
because we could
Yeah.
be in for an extra bump in the housing market that we weren't
Yeah.
expecting.
Yep. Yeah. And I think a lot of times people think of real estate, and especially the past few years, we've seen just massive gains in real estate. In some markets, you're starting to see some downside,
Yeah.
but people kind of forget that real estate can go down too. Like
Yeah.
it's not always straight up. And there can be some risk there. And it's not like the stock market, like you're buying a single asset,
Yeah.
that 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 asset may change in value, in ways that are different from the rest of
Yeah,
the market around the
depending on the
country.
market that you're in could
Yeah.
make a huge difference. You look at the overall US housing market, well, that's one thing, but then
Yeah.
comparing St. Louis to Atlanta metropolitan areas, that's two night
Hmm.
and day different
Right.
markets. You have a contracting population in St. Louis and
Mm.
in Atlanta where I live, it's like they're putting up a new subdivision inside every subdivision that's already there. Like,
Yeah.
let's pivot real quick. How do you
Yeah.
think this interest rate environment would affect bond buyers, people who are investing? I
Yeah.
mean, all of our clients have some level of bonds or fixed income for the most part. We
Hmm.
have maybe a couple of younger clients who are all equity, but
Right.
generally speaking, when rates go up and down, that affects
Hmm.
the prices of bonds. Are you looking at doing anything different in your fixed income portfolios, or how do you see this affecting people?
Yeah, yeah. So I've been kind of thinking about two different things as far as a fixed income side of the portfolio goes, because we buy fixed income for two different main reasons, right? One reason is stability in a portfolio. Typically fixed income, depending on the fixed income you're buying, doesn't move up and down quite as much as
Sure.
stocks do. And the other reason is for diversification. So there are kind of two different reasons that we're looking at buying fixed income. And in 2022, when interest rates shot up so much, interest rates going up, bad for bonds. Bond prices go down when interest rates go up. So the spot to be was sort of in short-term bonds, especially if you're investing in bonds for the stability aspect, right?
I mean,
Because
that's God, 2022. What a brutal year. Stocks
crazy.
crushed by 20+%
Hmm.
and bonds down 10%. And if you were in like high yield bonds or long-term stuff,
Hmm.
you just
Yeah.
got completely hammered the whole year.
Yeah.
That year was worse for you as an investor than the massive pullback we had in COVID was in
Yeah.
2020. And because
Well,
it
it was
wasn't a quick
longer.
pullback, it was just a grind,
Oh,
but it hit
yeah.
everything. It hit it all so hard because interest rates
Hmm.
affected bond prices so much.
Yeah. 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 So the diversification aspect of fixed income didn't really help you a whole lot.
No, it did not.
Yeah.
All the
But
millennial financial advisors, we all have such a chip on our shoulder against
oh,
bonds and bond funds.
yeah.
Whether it's me or you or our friend Rick Lucchini, like we all
Hmm.
kind of hate bonds and we want to have as
Yeah.
little of them in the portfolio as possible. Because all these studies that talked about safe withdrawal rates that were done in the 70s, well, like guess what, dude? Bonds were making 8.5% interest back then.
Yeah.
And at some points back then, but prime mortgage rates were hitting 16, 17%. So it's not
Yeah.
not the same environment it is now.
No.
And bonds have gotten crushed anytime I needed them to help me out, with like maybe one or
Yeah.
two exceptions.
Well, and maybe we're in a different scenario now, right? I mean,
Yeah,
when because kind of the math behind bonds and how they move changes at different levels of interest rates,
sure.
right? So if when coming out of COVID, I think the 10-year rate got down to like, I don't know, under 0.5%. Am I wrong
Yeah.
about that?
So
Okay,
is
so
this
not quite that low.
50, 60 basis
In
points
the 60s.
in March,
Yeah.
60, 70,
Oof.
down to 54, down to
Okay.
0.54%. You could
Yuck.
make 0.54% annualized to own
For
a
the next
10-year
10
investment.
years.
That is
Terrible.
woo, and that's why
Oh, man.
that's when you were getting a 2% mortgage refinance, and
Yeah.
those go hand in hand. And let me tell you,
Yeah.
and this is what I need people to understand, regardless of your political affiliations and all this other stuff and all your ideas that you bring to the table, you don't want to be in an environment where we have to slash rates to 0% and we get
Yeah.
2% mortgages again, because all
Yeah.
the stuff that leads to that is really, really not good. So
And what we found is it led to a lot of inflation, right? So yeah,
yes,
all of it just
It's
not good
it's
all
it's
around.
like eating all your groceries on like the first day after you grocery shop at home. Like, okay, I have so much food. My paycheck just hit. I'm going to go spend it all on a really great dinner. It might be a fantastic dinner. It's going to make for a really crappy 2 weeks until you get there.
Yeah.
Yeah.
No kidding.
Yeah. Well, we should definitely be policymakers. All right. I took us off of topic. We're going to say anything else about bonds, fixed income thoughts there?
Oh, yeah. So real quick, when interest rates are really low, if they move up 1%, then that is way worse for the price of bonds than if interest rates are already pretty high. So the way to look at that then is, when the 10-year rate was at 0.5%, there was a lot less return and actually more risk from an interest rate perspective, right?
Sure.
Interest rates came up, bonds went down way more than they would have if interest rates were already higher. Now we're at 4.5% or something like that. I don't know.
Yep. 4.23, 4.25.
So now you're it's a treasury, so I can say guaranteed. I always almost throw up when I say guaranteed, but
we're trained to not say guaranteed. You can't say guaranteed. You can't say guaranteed
unless it's treasuries. So backed by the U.S. government, over the next 10 years, you get a little over 4.2% if you buy a 10-year treasury. If interest rates go up a little bit, the 10-year treasury won't go down as much as it did back when interest rates were at 0.5%. And I don't know, I shouldn't say this out loud, but if you think about it, we were at 0.5%, we went up to 5% at one point. That's 10 times.
That's
right?
Huge.
What's the chance we go from 4% to 42%?
Yeah.
Unprecedented. Unprecedented, right? We'd be saying that. So
I always tell clients, like, hey, there's always the unknown, unknowable thing. And so we should never let our guard down. We should never abandon our down market strategy. But, 42% 10-year treasury. I mean, I guess at that point,
wild,
like,
right?
What is Venezuela making on its bonds right now? Like 4,200.
Yeah. And if we go to if we get into a situation where the economy starts to really turn negative and we need to cut interest rates, you're going to see more of a pop from bonds. So there's because interest rates can now be cut from 4% to 3%, from 4% to 2%.
Rates go down, prices go up. So if you're a bond buyer, the price of your bond, and I always explain to the clients in simple terms, like, hey, it's like if you had a CD, you bought the last 4.5% CD, and all the new ones coming out are at 3%. You could literally just turn around and sell your CD and make a profit, and it would just be it would be the interest that you would have made profit. And that's how you calculate that. And now you're selling it and you're getting out and you're making money off of it. So rates going down,
you're making money sooner.
Yes. Rates going down makes prices go up. And if you did that also in a year where the stock market was doing great and growing, you might just have our payback for 2022 being so brutal. Right? We might just get the pat on the back we needed.
We might see a rate cut because the economy is doing poorly. And because of that, the stock market might be down, right? So
then bonds would finally be helping us out, and this millennial financial advisor would stop resenting them so much.
Exactly. And so what this means from an investment standpoint, God, I'm getting so excited. We're so nerdy.
That's right.
What this means from an investment standpoint is that maybe if you're looking to bonds for diversification, get out of those shorter term bonds that are more stable, right? And maybe look to more longer term bonds that are going to move more with interest rate movements. There is, of course, more volatility to those, but volatility, as we talked about when we were talking about crypto, can be accretive to a portfolio because of the diversification benefit and rebalancing, right?
100%.
So that's the main point I wanted to make there.
So don't ditch your bonds. Don't overbuy on your mortgage. If you're a tactical bond investor, maybe now's the time to start looking at a little bit longer term securities. Consult with your financial advisor. Be smart with how you're investing your fixed income, and don't bank on mortgages going down when you're buying the house. Let's do it again, man. This was a lot of fun. Thank you so much for coming on.
Yeah, thanks for having me.
Bye. This show reflects the personal opinions and viewpoints of myself, Hamilton Brandenburg, and my guests. Opinions and viewpoints are subject to change at any time without notice. No representation is made as to the accuracy, completeness, or relevance of the information presented. The information discussed is general in nature and does not constitute investment, tax, or legal advice, so consult with your tax, legal, and financial professionals about your specific situation. Past performance does not indicate future returns, and any indices mentioned are for reference and cannot be invested in directly. Brandenburg Financial Services is a DBA of CS Planning, an SEC-registered investment advisor.